Have you ever dreamed of owning a home?
That classic American dream of a white picket fence, a yard for the kids to play in, and a place to truly call your own.
For many, a $500,000 home sounds like a reasonable, even modest goal. But what if I told you that in just a couple of years, by 2026, owning that very home could be a financial nightmare for all but the wealthiest families?
Today, we're going to break down the shocking true cost of a $500,000 home, and you might be surprised to find out who can actually afford it.
This isn't about scaring you. It's about preparing you with the real numbers. So, grab a calculator and let's dive into the financial reality that's just around the corner.
Let's start by painting a picture of this hypothetical $500,000 home.
It's not a mansion. Depending on where you live, it could be a starter home, a 3-bedroom suburban house, or maybe a nice condo in a city. It's the kind of home many hardworking people aspire to. Now, the first hurdle, the down payment. The gold standard is 20% to avoid private mortgage insurance, or PMI.
Now, let's assume you've performed a miracle and saved up that $100,000 down payment.
Congratulations.
You now need a loan for the remaining $400,000.
This is where things get really interesting. We need to talk about interest rates. While we can't predict the future with perfect accuracy, let's use a conservative estimate for 2026.
Given recent trends, a 30-year fixed mortgage rate of 6.5% seems like a plausible scenario.
It might be higher, it might be lower, but let's work with that for now.
Plugging that into a mortgage calculator, your principal and interest payment alone comes out to about $2,528 per month.
That's over $2,500,
and we haven't even talked about the other costs of homeownership yet.
This is just the bill for borrowing the money.
So, we have our principal and interest payment of around $2,528.
But wait, there's more, a lot more. Next up are property taxes.
This varies wildly by state and even by county, but a common national average is about 1.1% of the home's value annually.
For our $500,000 home, that's $5,500 a year, or about $458 per month. So, let's add that to our monthly total. We're now at just under $3,000 per month. But we're not done. You also need homeowners insurance. This protects your biggest asset from things like fire, theft, or natural disasters. A reasonable estimate is about $150 per month, though this can be much higher in areas prone to floods or hurricanes. Tacking that on, our monthly housing payment is now sitting at approximately $3,136.
Let's pause and recap.
Just for the PTTI, that's principal, interest, taxes, and insurance, you're looking at over $3,100 a month.
But a house is more than just a mortgage payment.
It's a living, breathing thing that needs constant care and feeding. Let's talk about maintenance and repairs.
A good rule of thumb is to budget 1 to 2% of your home's value each year for upkeep.
Let's be optimistic and go with 1%. That's $5,000 a year, or about $417 per month. This covers things like a new water heater, a leaky roof, or a furnace that decides to quit in the middle of winter.
These aren't if expenses, they are when expenses. Suddenly, our monthly cost has jumped to over $3,550.
That's more than $42,000 a year just to keep a roof over your head.
Now, we get to the really critical question. Who can actually afford this?
The standard financial advice is the 28-36 rule. This means your housing costs shouldn't exceed 28% of your gross monthly income, and your total debt, including car payments, student loans, and credit cards, shouldn't exceed 36%. Let's focus on the 28% rule for now. Let's put this into perspective. An income of $152,000 a year puts a household well into the upper middle class, easily in the top 20% of earners in the country.
We're talking about households with professionals like doctors, lawyers, engineers, or too high-earning individuals.
So, the dream of owning a simple $500,000 home is now, realistically, a dream reserved for the top quintile of earners. What does this mean for teachers, firefighters, nurses, and skilled tradespeople? It means that even with good, stable jobs, homeownership in many parts of the country is becoming an exclusive club they are priced out of. The very people who form the backbone of our communities are finding it impossible to live in them. This creates a massive social and economic divide, where the dream of building wealth through real estate is accessible only to those who are already wealthy. But what if you don't follow the 28% rule?
What if you decide to stretch your budget and become house poor? This is a dangerous path many are forced to consider. Let's say a family earning $100,000 a year decides to buy this home. Their housing cost of over $42,000 a year would eat up 40% of their gross income. After taxes, that percentage is even higher, likely over 50% of their take-home pay. This leaves very little room for everything else: groceries, transportation, healthcare, childcare, and God forbid, saving for retirement or an emergency. One unexpected car repair or medical bill could send the entire financial house of cards tumbling down. This level of financial stress takes a huge toll on mental health, relationships, and overall quality of life. It turns the dream of homeownership into a constant source of anxiety. So, what can you do? This reality check isn't meant to discourage you, but to empower you with knowledge. First, you need to be brutally honest about your budget and what you can truly afford, not what the bank says you can borrow. Lenders will often approve you for a much larger loan than is financially wise. Second, get creative. This might mean looking at smaller homes, different neighborhoods, or even different cities or states where the cost of living is lower. The rise of remote work has opened up new possibilities for people to live where they can afford to, not just where their job is located. Third, consider house hacking or multifamily properties. Buying a duplex, living in one unit, and renting out the other can significantly offset your mortgage payment. Finally, focus on increasing your income and aggressively paying down other debts. The lower your debt-to-income ratio, the more financial flexibility you'll have. And most importantly, don't let societal pressure push you into a decision that will ruin you financially. Renting is not throwing money away. It's paying for a place to live, and in many cases, it could be the smarter financial choice, allowing you to save and invest the difference. The housing market is in a state of crisis, but by being informed and strategic, you can still navigate it successfully. The key is to redefine what the American dream means for you, based on your own financial reality and personal goals, not on an outdated fantasy. The dream is financial security, and homeownership is just one possible path to get there, not the only one. Thanks for watching, and I hope this gives you a clearer picture of what you're up against. Don't forget to like and subscribe for more real talk about personal finance. Let's talk about something that's on everyone's mind: the housing market. For generations, owning a home has been the cornerstone of the American dream. It symbolized stability, success, and a secure future. But for millions today, that dream feels more like a fantasy. We are in the midst of a housing crisis that is fundamentally reshaping our society and our financial futures. And we need to have a serious conversation about what's really going on. It's not just you. If you feel like homeownership is slipping out of reach, you are not alone. The numbers don't lie. Let's look at the data. Over the last few decades, and especially in the last few years, home prices have skyrocketed, far outpacing wage growth. In many cities, the median home price is now 10, 15, or even 20 times the median annual income. Think about that. The traditional advice was to spend no more than 3 to 4 times your income on a house. That's simply not possible for the vast majority of people anymore. So, what's driving this? It's a perfect storm of factors. First, we have a chronic shortage of housing supply. For years, we haven't built enough homes, especially affordable starter homes, to keep up with population growth. When demand outstrips supply, prices inevitably go up. This isn't just about a few popular cities anymore. It's a nationwide problem. Then, we have the issue of interest rates. When rates were historically low, it fueled a buying frenzy. People could borrow more, which pushed prices even higher. But now, as rates have risen to combat inflation, it's a double-edged sword. Not only are home prices still astronomically high, but the cost of borrowing money to buy one has also shot up. This means monthly mortgage payments are reaching levels that are simply unaffordable for the average household, even for those with good jobs and decent savings. Let's break down what this means in real terms. A monthly mortgage payment is now often higher than a monthly rent payment for a comparable property. This traps people in the rental market, where they face their own set of challenges, like rising rents and a lack of stability. They see and save for a down payment because a huge chunk of their income is going to their landlord. It's a vicious cycle, and let's not forget the role of large-scale investors. In recent years, private equity firms and institutional investors have been buying up single-family homes at an alarming rate, turning them into rental properties. They can pay in cash,
outbidding regular families and further reducing the already limited supply of homes for sale.
This transforms housing from a fundamental human need into a speculative asset class, traded on Wall Street like any other commodity. When this happens, ordinary people are the ones who lose out. This isn't just a financial issue, it's a social one. The inability to afford a home has profound consequences. It delays major life milestones like starting a family.
It creates a wider gap between the wealthy who already own property and everyone else.
It forces people into longer commutes as they move further and further away from job centers in search of anything they can afford. This strains our infrastructure, impacts our environment, and erodes the fabric of our communities. So, where do we go from here? This problem is complex, and there are no easy answers.
But pretending it doesn't exist is not an option.
We need to look at this from multiple angles. On a policy level, we need a serious commitment to increasing housing supply. This means reforming zoning laws to allow for more diverse types of housing, like duplexes and townhomes, not just single-family houses. It means incentivizing the construction of affordable and middle-income housing. We also need to look at the demand side. Are there ways to level the playing field so that an ordinary family isn't competing with a multi-billion-dollar corporation to buy a home? This could involve tax changes or regulations that make it less attractive for large-scale investors to dominate the single-family home market.
And for individuals, it requires a major mindset shift. The pressure to buy a home at any cost can be immense.
But stretching yourself to the absolute financial limit is a recipe for disaster. We need to be brutally honest about afford. A house is not just a mortgage payment.
There's property tax, insurance, maintenance, unexpected repairs. These can add up to thousands of dollars a year. Being house poor, where all your money goes into your property, is not a secure or enjoyable way to live.
This might mean redefining what the dream looks like. Maybe it's not a single-family home with a white picket fence right away. Maybe it's a condo or a townhouse. Maybe it's renting for longer and investing the difference wisely to build wealth in other ways. There is no shame in that. Financial stability is the real goal, and homeownership is just one potential path to get there, not the only one. The reality is that we are at a critical juncture. The current trajectory is unsustainable. It is creating a generation of people who may never have the same opportunities for stability and wealth creation as their parents did.
This isn't about blaming individuals for not saving enough or not working hard enough.
This is about acknowledging a systemic failure in the market and in our policies. The conversation needs to be louder. We need to demand more from our elected officials. We need to support policies that prioritize housing as a fundamental right, not just an investment vehicle. And on a personal level, we need to have honest conversations about our finances, our goals, and what true stability really means for us. The housing crisis is one of the defining challenges of our time.
Ignoring it won't make it go away.
It's time to face the numbers, understand the forces at play, and start working towards real, sustainable solutions.
Let's continue this conversation.
Share your thoughts and experiences in the comments below. What does the housing market look like where you are? What solutions do you think could make a difference? Thank you for watching.